How to beat inflation. Bonds. Bonds are a type of investment that gives you the ability to earn interest. A bond is essentially an IOU that's issued by a government or corporation. Unfortunately, in low interest rate environments, it can be difficult for a bond to beat inflation. In most cases, investors are locked in to fixed rates of interest and could find themselves on the losing end if inflation rises above their bond's rate of interest. When you buy a bond, you're lending money to the issuer, who promises to pay back your principal at some point in the future, plus a certain amount of interest. There are several different kinds of bonds, and they all have their own unique characteristics. A corporate bond is a debt security issued by a corporation or other business entity. Corporate bonds typically have maturities ranging from less than a year to more than 10 years. Corporate bonds generally have higher yields than both government and municipal bonds. Municipal bonds. A municipal bond is a debt security issued by a state or local government to raise funds for projects such as infrastructure development, schools, hospitals, housing, and roads. Municipal bonds are exempt from federal taxes but are usually subject to state and local taxes. Municipal bonds generally have lower yields than corporate bonds, but higher yields than treasury bills or notes. Government bonds. Government bonds are issued by the federal government to finance public projects such as building roads or funding social programs. Government bonds are considered very safe investments because they're backed by the full faith and credit of the federal government. Offshore bonds. Offshore bonds are a type of investment that expatriates can make in their home country. This is an alternative to traditional investments like stocks and bonds, which may not be available to expats or won't provide the same benefits. They can be used to diversify your portfolio. Many expats choose offshore bonds because they allow you to avoid paying taxes on interest or capital gains on your investments, as long as you keep them outside of your home country. Tip: beat inflation with floating rate bonds. Floating rate bonds offer a non-fixed interest rate, meaning the interest rate varies with market conditions. This can allow for a guaranteed return on your investment, regardless of inflation rates. You can buy these bonds through ETFs or mutual funds. ETFs and mutual funds tend to offer a wide assortment of such bonds. For more information on how to beat inflation, check the link in the description.